Understanding which tax exemptions and reductions you can claim in Denmark is essential to making informed financial decisions and ensuring you are not paying more tax than necessary. And in this video, we will walk through the key categories most individuals and families should be aware of, with a clear and structured overview that reflects how authorities and professional advisors typically approach these topics. Denmark is known for relatively high headline tax rates, but the effective burden can be significantly reduced once you factor in personal allowances, employment-related deductions, pension contributions, and specific reliefs tied to interest, transportation, and certain investments. The starting point is the personal allowance, or personfradrag, which functions as a basic tax-free amount that everyone is entitled to. This allowance is automatically applied by the tax authorities, scales with age, and effectively reduces your tax base before other calculations take place. Beyond this, most employees benefit from the so-called employment allowance, or beskæftigelsesfradrag, which is a percentage deduction based on your earned income from work. This is also handled automatically, but it is important to ensure that your income has been correctly reported so you can receive the full benefit. If you are commuting to work, you may be entitled to a transportation deduction, known as kørselsfradrag, or the commuter allowance, which can be significant for those traveling longer distances. The deduction depends on the number of kilometers between your home and workplace and the number of days you commute annually, and you must actively ensure that the correct distance and work days are recorded in your preliminary income assessment or forskudsopgørelse, as it will not be estimated for you by default. Interest deductions represent another important category. If you pay interest on loans, including mortgages, student loans, or consumer loans, part of that interest is typically deductible against your taxable income. The tax authority often receives data directly from banks and mortgage institutions, but you should review the pre-filled information in your annual tax statement, or årsopgørelse, to confirm that all interest payments are accurately reflected and that any private loan arrangements are correctly registered. Pension contributions are a central instrument both for long-term financial planning and for optimizing your tax position in Denmark. Payments into certain pension schemes, such as employer-administered pensions or specific private plans, can often be deducted within defined limits, reducing your taxable income today while building retirement savings for the future. The rules differ between rate pensions, annuity products, and lifetime pensions, including annual caps on deductible contributions, so it is advisable to align your contributions with those thresholds to avoid missing out on available tax advantages or unintentionally exceeding the deductible ceiling. If you are paying into an alderssparing or age savings account, the tax treatment is different. Contributions are typically not deductible, but payouts are tax-free, so the choice between products should be made holistically, reflecting both your current marginal tax rate and your expectations for future income and flexibility. For homeowners, property-related taxes and deductions also play an important role. While the specific regime is evolving over time with reforms to the property valuation and taxation system, interest on mortgage loans remains deductible, and you may experience indirect relief through capped tax increases and transitional arrangements, especially when moving into a newly valued property. It is therefore prudent to monitor communications from the tax authority on your property assessment and to review how property values and related taxes appear in your annual statement. Another area where taxpayers often overlook potential savings is work-related expenses that are not reimbursed by the employer. In limited cases, you can claim deductions for necessary job-related costs, such as professional literature, tools, or special work clothing, provided these expenses are directly linked to your employment and exceed any minimum thresholds set by the current rules. While this category is narrower than in some other countries, it can still be relevant for certain professions, and careful record-keeping is essential if you intend to make such claims. Charitable donations to approved organizations in Denmark can also reduce your tax bill. Contributions to registered charities, cultural institutions, or certain NGOs are subject to annual limits, but are typically reported automatically when your CPR number is registered with the donation, so you should verify that your contributions appear correctly in your tax overview and supplement them where necessary. Families with children should be aware that while many benefits, such as child benefits, are administered outside the ordinary income tax system, there can be specific deductions or tax-relevant support mechanisms tied to childcare, education, or special needs, depending on current legislation and municipal arrangements. Keeping an eye on official guidance and updating your tax information when your family situation changes can help ensure that you are accessing all relevant benefits. If you receive income from investments, such as dividends, capital gains, or rental income, the tax treatment can be more complex, but there may still be exemptions, threshold-based reliefs, or different tax brackets that lower the effective rate on certain types of income. For example, Danish tax law distinguishes between share income and capital income, each with its own brackets and thresholds, and there may be more favorable rates on gains within certain limits, or on holdings kept in specially designed investment accounts with preferential treatment up to a defined yearly deposit. For individuals with cross-border elements, such as foreign income, property abroad, or time spent working in other countries, Denmark's extensive network of double taxation treaties can provide meaningful relief, preventing the same income from being taxed twice. However, accessing these benefits typically requires that you accurately report foreign income, understand where you are tax resident, and in some cases proactively claim relief or credit for tax paid abroad. Throughout all of these areas, one consistent theme is that while many Danish tax advantages are applied automatically through information reported by employers, banks, pension providers, and other institutions, the responsibility for accuracy remains with you as the taxpayer. A disciplined approach involves reviewing your preliminary tax assessment at least once a year, updating it when your life circumstances change, such as moving, changing jobs, taking on new loans, or experiencing major shifts in income, and then carefully checking your annual tax statement when it is issued. Small corrections, such as adjusting your commuting distance, adding overlooked interest expenses, or fine-tuning pension contributions, can cumulatively have a significant impact on your net tax position. Leveraging the digital tools offered by the Danish Tax Authority, including online overviews of deductions and interactive guides, can simplify this process. For more complex situations, such as owning a business, managing substantial investments, or dealing with multiple countries, it can be worthwhile to seek professional advice to ensure that you are utilizing the full range of exemptions and reductions available under current Danish law. By understanding the main categories, personal allowances, employment deductions, commuting relief, interest and pension deductions, approved donations, selective work-related expenses, property-related rules, investment income treatment, and cross-border relief, you place yourself in a much stronger position to navigate the Danish tax system confidently, remain compliant, and avoid leaving money on the table.